2 years ago, if I'd run this same search, I would have handed you a list of 30 suburbs. 30. I ran it again last week, period ending March 2026. I got just 5. And only 2 of them actually cleared the 5% yield bar. The other 3 came close, but not quite. If you think you know what's happened to Tasmanian yields in the last 12 months, you might want to see this number. Before we dive in, if you're new to the channel, I'm Sean and I run PropSpotter. We're a property investment framework built on 3 pillars: research, source, and coach. What that means in practice is this: we use over 30 institutional grade data sources to identify the right suburbs for your strategy. Then our proprietary listing system monitors those suburbs 24/7 and alerts you the moment a new property goes live, before most investors have even opened domain or real estate that morning. And then we coach you through every step from evaluation to settlement via a dedicated WhatsApp group. It's everything a buyer's agent provides: the research, the sourcing, the guidance. Except you keep the skills, you stay in control of every decision, and it costs a fraction of the price. We've coached over 50 investors across Australia with a perfect 5-star rating on Google. If you want to learn more, the link to book a free strategy call is in the description. Now, let's get into the data. I want to be really honest with you from the start, because if you take away just one lesson from this channel, it's this: the number one way property channels coerce investors is by showing you the headline without showing you the cost of getting the headline. This video is titled 5 Tasmanian suburbs under $500,000 with 5+% yields, because that is the criteria that matters. Cheap enough to actually buy in a tightening lending market. High enough yield to service the loan without bleeding cash. Here's the uncomfortable truth. As of March 2026, across Tasmania, the whole state, I could find you exactly 2 suburbs that cleared both bars. So what I'm going to do in this video is give you the 5 closest to criteria suburbs, be transparent about where each one sits against the benchmark, and tell you what I think about each as an investment. 2 of them hit 5%, 3 don't, but they're the closest you can get without paying more. This is the list, and more importantly, the reason this list is so short is itself the story of what's happened to Tasmanian property in the last 12 months. Before I get to the short list, I want to explain what happened. Because if you're newer to Tassie, the yields you're seeing on property listing portals right now are not the yields that existed in 2019 or 2020. From the hashtag data, the 10-year annualised price growth for mainstream Tasmanian suburbs, Launceston, Brighton, Glenorchy, Hobart's outer rings, has been sitting in the 10 to 13% range. That's compounded annualized. Let me put that in dollar terms. A house that was $250,000 in 2016 is in many Tasmanian suburbs over $600,000 today. Rents have moved too, but not at the same pace. From the hashtag data, the 10-year annualized rent growth for the same suburb groups is 6 to 6.6%. Rents have doubled in rough terms over the decade, while prices have tripled. The output: gross yields have been compressing by between 3 and 5% per year on an annualized basis. What was a 6% yield suburb in 2018 is a 4% yield suburb today. That is the single most important macro fact about Tasmanian property and even the whole country right now. Now, there's a bull case in this. Yield compression driven by price growth is a completely different story to yield compression driven by rent collapse. Tassie's compression is entirely from price growth, which means if you're a cash flow first investor, what you're being asked to do is buy at a higher price entry for a lower initial yield in exchange for what has historically been aggressive capital growth. Whether that trade-off makes sense for your portfolio depends on your goal. Coming up to retirement and wanting income, the yield compression makes Tassie much harder to justify today. 25 years to retirement with an accumulation strategy, the growth profile still matters. Now, with that context, here's the list. Methodology in 60 seconds because it matters. I used hashtag with the period ending 31st March 2026. Houses only, all bedrooms, gross yield at a suburb level. I filtered across every LGA in Tasmania where hashtag has medium to high confidence for the metric. I ranked by yield, applying the under $500,000 ceiling, and surfaced the top 5. 2 important things about this data set. Firstly, hashtag uses typical price, which is a statistically weighted central estimate, not a simple median. It's more stable than median in low volume suburbs. Second, gross yield here is the hashtag calculated yield using matched rent and price data for the same period. So we're not comparing a 2023 rent to a 2026 price, which is a trap you see in a lot of listed data. Now, with the methodology locked down, here's your countdown. Starting at number 5, building to the one suburb that's the highest yield under $500,000 in the entire state. Number 5, Georgetown. Postcode 7253. LGA is Georgetown Council, Northern Tasmania at the mouth of the Tamar River. Let's talk numbers. It's a $472,000 typical house price with a $380 a week rent. Gross yield 4.2%. 1 year price growth 7.56%. 10-year annualized growth 10.6%. Why it's on the list? It's a relatively small place, population scale of 4,500 and 120 houses annualized. It gives this a much more liquid feel than most under $500,000 Tassie options. The yield is 4.18%, noticeably short of 5%, and the headline driver behind Georgetown's story, the Bell Bay Industrial Precinct, is a single point of failure. Concentration risk for the local economy. If Bell Bay softens, Georgetown softens. The trade, a lower yield, higher liquidity, Tasmanian cash flow entry with a credible growth profile. Good for a first Tassie investment where you want to avoid the volatility of tiny volume suburbs. Number 4, Ravenswood, postcode 7250. Part of the Launceston City Council. So you get a Launceston LGA amenity profile at an outer ring entry point. Numbers, $465,000 typical value, $390 a week, yield of 4.3%, 1 year growth of 16.7%, and a 10-year growth rate of 11.8% per annum. The standout here is the 1 year growth rate number. 16.7% in the last 12 months puts Ravenswood among the fastest moving markets in real estate. That's a double-edged sword. It's obvious uplift momentum, but it also means Ravenswood has moved through the cycle. This is later stage cycle entry, not early stage. Historically, Ravenswood has been one of the more socio-economically concentrated suburbs in Launceston. That drives the yield. Cheap entry, solid rents, but it also drives the capital growth volatility. The trade. If you're comfortable with a late cycle entry and a stronger rental-based dependency, this is a higher quality Launceston metro option than some of the more remote Tassie plays. Number 3, Mayfield, postcode 7248, Launceston's north, again part of Launceston City Council. This is the one that missed the 5% benchmark by the narrowest margin. Numbers, 420,000, typical rent $395 a week, gross yield of 4.9%, 1 year price growth 17.02%, and a 10-year growth of 11.6% per annum. Mayfield is in the most affordable decile of all Australian suburbs relative to local income. Mayfield is structurally cheap. The 1 year price growth is strong. The yield is within rounding distance of 5%. And for more practical purposes, if you happen to buy slightly below the typical price and negotiate on a property that needs a cosmetic refresh, you can get this into a 5 handle easily. The honest flag, Mayfield has a lower socioeconomic profile than most of Launceston, and the hashtag lower risk score sits at 7 out of 100. Tenant quality, management, and property manager selection matter more in this suburb than in most. The trade. Mayfield is the classic Launceston area cash flow compromise. You accept a slightly more intensive management profile in exchange for the best yield to price ratio in the Launceston belt. Number 2, Gagebrook, postcode 7030, Northern Outer Hobart, Brighton Council LGA. This is the first suburb to clear 5% gross yield. $434,000 typical price, $430 a week in rent, 1 year growth of 10.3% and a 10-year growth of 11.7% per annum. Gagebrook. I've driven past there in a previous video. It's 25 minutes from Hobart CBD along the Brooker Highway, part of what is traditionally one of Tasmania's lowest socioeconomic pockets. Concentrated public housing legacy, low median household income, higher tenants turnover than state average. And that, ladies and gentlemen, is precisely why the yield is 5.15%. Markets price risk, and Gagebrook carries a real concrete property management risk that Central Hobart and Central Launceston suburbs don't. The hashtag lower risk score here is 1 out of 100, the lowest quintile. Capital growth score 1 out of 100, but we saw 10% last year. Volatility index 5 out of 10. This is on paper an extreme profile cash flow play. The opportunity, and I want to be measured here, is twofold. First, the 10-year growth track record is actually strong at 11.7% compounded, despite the low current cycle growth score. Second, the proximity to Brighton Council's major industrial and employment expansion corridor is a medium-term macro positive. The trade. This is not a suburb for passive landlords. It's not a suburb for your first investment. For an experienced investor with a strong property manager relationship on the ground and in a portfolio that can absorb the management intensity, the yield is among the best in the state at this price point. And number 1, without further ado, Herdsmans Cove. Postcode 7030, also in the Brighton Council LGA. Same general corridor as Gagebrook, same broader market story, but the specifics diverge in an interesting way. Numbers $450,000 typical, $450 a week with a gross yield of 5.16%, a 1-year growth of 10.8%, and a 10-year annualized capital growth rate of 13.08% per annum. The best 10-year growth track record on the entire shortlist. Why Herdsmans Cove edges out Gagebrook? The 10-year rate of 13.08% is a full 1.5 above Gagebrook. And the cash flow score on hashtag of 96 against Gagebrook's 89 reflects more consistent sales and rental volume history. The honest context. Herdsmans Cove has the same concentrated socioeconomic profile as Gagebrook. It emerged from a similar public housing heritage. The HAPI score of 6 is actually better than Gagebrook's 8, meaning marginally more affordable relative to local incomes, which lends to a flaw of tenant affordability. The trade. If you can buy well in Herdsmans Cove, and that means a property manager who understands the market, plus buying a home with sound structural bones, you're entering the highest yielding suburb under $500,000 anywhere in Tasmania on current hashtag data, with a capital growth track record that's actually the strongest on the list. Here's the full shortlist on the screen now, ranked by yield on one screen. 2 observations. The first, the fact that we've got only 2 5-handle yield suburbs under $500,000 in the entire state is the market telling us something structural. Tasmania is no longer a headline cash flow state. If you want a 6% or 7% yield at entry, you're now looking at regional New South Wales, parts of Queensland, Northern Territory, not Tasmania. Second, 3 of the 5 suburbs on this list sit in concentrated socioeconomic pockets. That's not an accident. The last pockets of cheap plus high yield property in Tasmania are disproportionately in areas with historical public housing legacy, tenant management intensity, and capital growth volatility. You need to be comfortable with that reality, or this isn't the state for your cash flow thesis. If that doesn't sit with you, the better play inside a Tasmanian strategy today is mid-range suburbs at the $550,000 to $650,000 band, where capital growth trajectory is stronger and management intensity is meaningfully lower. The trade-off is accepting a 4 to 4.3% yield entry point. If this video was valuable, 2 things help the channel. Subscribe if you haven't, and drop in the comments whether you think a Tasmania cash flow play under $500,000 still makes sense in 2026, or whether you'd rather be in a growth first state at this point in the cycle. I'm genuinely interested in the range of views. And if you want this kind of analysis personalized to your own strategy, your own budget, your serviceability, your yield requirements, that's exactly what PropSpotter is built for. Book a free 20-minute strategy call with my team. Link is in the description. I'll see you on the next one.